Welcome to the MarketRent Weekly Brief, your go-to source for the latest insights and updates in the real estate market. Each week, we'll bring you the most important news and trends to help you stay informed and make smart decisions. Let's dive into this week's episode.
Okay, let's dive in then. We've got the material you shared, and it's really focused on an interesting angle within Section 8, hasn't it?
Yeah, it's all about how to strategically enhance property performance.
Yeah.
Specifically looking at market alignment.
Right, market alignment. We've talked about the potential before, but today feels like we're drilling down into a specific method your source has mentioned, an innovative one.
That's right. It's a methodology designed to sort of turn that potential into real results. So what we're really trying to do in this deep dive is unpack that strategic approach, understand how it actually works, how it helps owners and investors make, smarter decisions.
And unlock value that might be hiding there.
Exactly. And it really frames it as a strategic partnership focused on that long-term value.
Right. So seeing opportunity instead of just, complexity.
Yeah.
Okay, so to get into this, maybe let's start with the usual way. The traditional path, if you have a Section 8 property and you want to check if your rents are like market aligned, you use HUD's rent comparability studies, the RCS, right? Typically during contract renewal.
That's the standard process, yeah. And the traditional RCS, it's absolutely vital. It's how HUD figures out the legitimate market rent.
Mm-hmm.
But, and this is what material highlights, it's a pretty big commitment up front, You invest time, money, resources.
Into the full study.
Right, into the full study before you actually know what the outcome will be. The final rent number only comes after the whole thing is done and dusted.
And that, I imagine, creates some strategic headaches for owners, for investors, like wondering if it's even worth doing the full study.
Exactly, that's a big one. Or think about an acquisition team. They're doing due diligence.
Right, tight timelines.
Yeah, they need to understand the property's market alignment potential fast, to factor it into their offer, their valuation. But committing to a full, detailed RCS right then, it's often just not feasible or, frankly, strategic at that stage.
Makes sense. What about owners with, say, several properties, a portfolio?
Well, for portfolio owners, they might have multiple properties needing this kind of look.
Mm-hmm.
How do you prioritize? Where do you put your resources first?
You need a way to figure out which ones have the most upside potential first.
Precisely, before spending significant money across the board. And then you've got properties maybe facing really tight renewal deadlines. They need insights quickly. So the traditional way, that big upfront investment, without knowing the likely payoff, it creates these kinds of strategic bumps in the road.
Okay, so that really sets the scene. There's a clear need for something, more strategic upfront, more data before the big leap.
Uh-huh.
And that brings us to this new idea, right? The strategic phased RCS methodology. How does this change things? How does it transform that process?
It's presented as a real shift in thinking. It takes that necessary comprehensive RCS, but it breaks it down into strategic phases.
Okay.
The whole point is using data at each stage to decide whether to move to the next one. It's about, applying those market alignment principles, but getting clarity much, much earlier, especially finding those opportunities where rents might be genuinely below the market.
So like steps instead of one giant jump. Okay, walk me through step one then. Preliminary rent assessment. What's the goal there?
Phase 1 is all about giving you a clear, data-backed picture of the property's opportunity, the market alignment opportunity. It's an initial look, but it's pretty thorough.
Okay, so understanding the potential before you commit to the full cost.
That's the core idea.
What kind of analysis goes into that first phase? The source mentions a strategic market analysis.
Yeah, that involves a few key things. First, you look at where the property's current rents stand compared to HUD's small area fair market rents, the SAFMRs.
Right, gives you market context.
Exactly, huge context. Then there's preliminary research into comparable properties. What are similar places nearby actually getting in rent? What do they offer? How does your property stack up initially?
Sort of getting the lay of the land, see what the competition looks like.
Precisely. But it also goes a bit deeper. A really key piece in Phase 1, highlighted in the material, is assessing and documenting any non-shelter services.
Non-shelter services. What falls into that?
Things like specific programs for residents, maybe enhanced security features, community spaces, or amenities that go beyond the basics. Services that add real value but often aren't, properly accounted for in the basic rent calculation.
Oh, okay. The value adds that sometimes get missed.
That's often where hidden opportunity lies, according to the source. Phase 1 specifically looks to value those.
Interesting. How else does phase 1 build that picture of potential?
Well, it includes a statistical analysis. Based on all that initial data, the SAFMRs, the preliminary comps, the non-shelter services valuation, it estimates a range of potential property performance enhancement.
So it doesn't give you a final number, but like a ballpark,
Mm-hmm.
a potential target range.
Exactly. A data-backed range of what might be achievable through market alignment. And crucially, the deliverable from phase 1 isn't just the analysis, it's a clear recommendation.
A recommendation.
Yeah, based on the data. Does it look like there's a strong enough opportunity to justify moving forward with the full comprehensive RCS in phase 2?
Right.
Or does the preliminary data suggest maybe the potential is limited right now?
Okay. So the big takeaway from phase 1 is really understanding the size of the market alignment opportunity and getting a strategic thumbs up or thumbs down on investing more.
You got it. You get those crucial insights, but at a much lower initial investment compared to diving straight into a full RCS.
That makes a lot of sense. It's about informed decision-making right from the start.
That's the value proposition. Data to make a strategic call.
And logically, if phase 1 does show that significant opportunity, then you proceed to phase 2, comprehensive market alignment.
Correct. Phase 2 only happens if phase 1 validates that potential for real property performance enhancement. And importantly, the cost of phase 1. That investment is typically credited towards phase 2 if you move ahead.
Oh, that's good. So you're not paying twice for the initial groundwork.
You're right.
And phase 2 is essentially doing the full HUD-ready rent comparability study.
Yes. This is where the complete RCS development happens. It means a full, detailed property inspection, much deeper documentation than in phase 1. You're doing a really strategic selection of comparable properties and detailed analysis to justify them rigorously.
Building that solid case for HUD.
Exactly. It involves comprehensive calculations for all the adjustments, features, condition, those non-shelter services again, location, etc., everything needed to support the market alignment request. Then preparing the actual report in the specific HUD format, and coordinating the submission as part of the Section 8 contract renewal.
So the end product of phase 2 is that submission-ready RCS. And the idea is, because it was built on the strategic validation from phase 1, it's designed to really maximize the property's legitimate market position.
That's the strategic flow. Phase 1 finds and validates the opportunity. Phase 2 executes the detailed work to realize it, backed by data.
Okay, let's talk about the advantages here. The source outlines several ways this phased approach creates new opportunities. First up, resource allocation. How does it help there?
Oh, this is a big one for property owners. Instead of maybe feeling obligated to budget for a full RCS every time or for every property.
Which can get expensive fast.
Right. This lets you invest strategically. You put in the phase 1 investment to check the potential return, to validate the enhancement opportunity. Then the data from phase 1 tells you whether it makes sense to allocate the bigger budget for phase 2 and maybe which properties to prioritize. It's just a more data-driven way to manage your resources.
So you're placing your bets based on actual evidence, not just a hunch. What about for acquisitions? Someone looking to buy a Section 8 property.
Oh, huge potential there. During due diligence, an acquisition team can use phase 1, get those critical market alignment insights at a strategic cost before they even close the deal.
Wow, okay.
That gives them powerful data for their purchase decision. Understanding that potential future rent growth, that feeds right into valuation, negotiation. It can genuinely uncover hidden value others might miss.
Yeah, that could really change the dynamics of a deal. And for the portfolio owners we mentioned earlier.
It becomes a really practical portfolio management tool. You can run phase 1 assessments on several properties, compare the validated potential side by side.
And see where the biggest bang for your buck is likely to be for a full RCS.
Exactly. It lets you focus your resources where the data suggests the greatest return on that investment. Really helps with strategic planning across the whole portfolio.
Makes sense. The source also mentions accelerated strategic insights. Sounds crucial if you're up against a deadline.
Absolutely. You know, those imminent Section 8 contract renewal deadlines, sometimes you need good information, fast, to make the right call. Phase 1 can deliver those critical market alignment insights much quicker than starting a full RCS from scratch. Gives owners a clearer view of their options in a compressed time frame.
Get the key info you need when you really need it. And the last advantage listed is interesting, an educational partnership approach.
Yeah, I like this one. It ties back to transparency. Because the process is phased with data delivered step by step, it really helps owners understand their property's specific position in the market.
So demystifies the process a bit.
I think so. It highlights the specific things, maybe those non-shelter services we talked about, or a gap between current rents and true market comps that are driving the enhancement opportunity. It makes it feel more like a partnership, working together to explore and realize that potential using data.
So it empowers the owner with knowledge. That's great. The source actually includes a case study, a strategic partnership case study, to illustrate this. Can you walk us through that?
Sure. It involved an 83-unit Section 8 property. It was in a pretty high-growth market out on the West Coast.
Okay. And the situation?
The issue was the property's rents had only ever been adjusted using HUD's OCF, the operating cost adjustment factor, for about 10 years straight.
So just keeping pace with operating costs, not market changes.
Exactly. OCF doesn't capture shifts in the local market or improvements to the property or those value-added services. So the ownership team, they were genuinely uncertain if a market-based RCS would show any room for rent enhancement at all.
10 years is a long time to rely just on OCF, especially in a high-growth area.
Mm-hmm.
So what did the Phase 1 assessment find?
The Phase 1 results were pretty eye-opening for them. The preliminary analysis pointed to a potential rent enhancement through market alignment in the range of 12 to 17%.
Wow, 12 to 17%. That's significant.
It really is. And crucially, Phase 1 specifically flagged that the data strongly supported making adjustments for the property's non-shelter services. That pinpointed where a good chunk of that overlooked opportunity was.
So it validated the potential and highlighted a key driver. What did the owners decide based on that Phase 1 data?
Well, seeing that clear data-backed potential for substantial annual revenue enhancement gave them the confidence they needed. They made the strategic call to proceed to Phase 2, the comprehensive RCS.
Makes sense. And the final outcome. Did they achieve that enhancement?
They did. The full RCS developed in Phase 2 successfully justified and supported significant rent increases, pretty much in line with what Phase 1 suggested. This led directly to a major boost in annual revenue enhancement for the property.
That's a fantastic example. Really shows how that phased approach took the guesswork out of it for the owner. They moved forward based on validated potential, not just hope or uncertainty.
Exactly. It turned that big question mark they had into a clear, data-driven strategic path.
So thinking about this approach in that case study, where does this phased methodology really add the most value? The source points out a few key scenarios.
Yeah, it seems particularly strong where there's just uncertainty about the market alignment potential. Phase 1 cuts through that fog, and as we discussed, it's a powerful tool for strategic acquisition analysis, quick, data-driven insights during due diligence.
Right. Helps buyers make smarter offers.
Definitely. It's also ideal for resource-conscious strategic planning. If budgets are tight, you invest incrementally. You only go for the full study if Phase 1 shows it's likely worthwhile.
Smart way to manage funds.
And for those time-sensitive strategic decisions, like near renewal time, it gets you critical information quickly.
Gets you the core data when the clock is ticking.
Right. And lastly, for portfolio enhancement strategy, using Phase 1 across multiple properties helps owners strategically prioritize where to invest in the more expensive comprehensive studies, focus resources for maximum impact.
It really does seem to come back to using data smartly to find those opportunities. Now, you mentioned earlier this approach uses analyses like SAFMR analysis and non-shelter services valuation.
That's right. It leverages those tools effectively. Phase 1 is specifically designed to spot potential below-market Section 8 rent situations. It does that by comparing current rents to the SAFMRs and those preliminary market comps.
Yeah.
And then it works to quantify the specific market alignment opportunities by digging into potential adjustments, really paying close attention to that non-shelter service value that might not be fully captured yet.
So it helps zero in on where that hidden value might actually be located.
Mm-hmm.
Are there signs maybe that a property owner should look for? Indicators that suggest they might really benefit from exploring this phased approach?
The source suggests a few things to watch for. Properties that have, consistently just taken the OCF adjustments year after year without doing a market study, that's a potential flag.
Okay.
Or properties where the current rents just seem obviously lower than the published SAFMRs for the area. Also, properties that offer significant non-shelter services but maybe haven't tried to get value for them in the rent structure.
Or maybe recent upgrades.
Exactly. Recent property enhancements that haven't been reflected in rents yet. Any of those could be signs that there's potentially significant unrealized opportunity there. Opportunity that a data-driven assessment like Phase 1 could uncover.
Sounds like those are definitely situations where a Phase 1 preliminary rent assessment could be a really smart first step.
That's positioned as the strategic starting point, yes, that preliminary rent assessment. It's designed to deliver those comprehensive initial insights relatively quickly, build that foundation for a strategic decision.
Right. It's all about making an informed decision, knowing the potential upside before you commit fully.
Precisely.
Hearing all this, it really does feel like this phased RCS approach is more than just a tweak. It's presented as a kind of strategic evolution, isn't it?
I think that's fair.
Taking a necessary process, market analysis, and turning it into a methodical, data-driven strategy. One that empowers owners to find value, enhance their property's performance, just by making smarter choices based on data at each stage.
Yeah, it shifts the focus from just compliance or uncertainty towards strategic opportunity with data lighting the way.
This has been really valuable, a fascinating look at a different lens for viewing market alignment in Section 8, framing it positively as this chance for strategic enhancement.
And it underscores again how digging into the right data, like non-shelter services or SAFMR comparisons, can really unlock value that might just be sitting there untapped.
Definitely food for thought. So as we wrap up this deep dive, maybe a final thought for you, the listener, to ponder. Think about your own portfolio or properties you know. Where might there be potential unlockable value, hidden potential that data-driven insights could reveal? Could turning that uncertainty into a clear strategy for enhancement be your next big opportunity?
That's it for this week's edition of the MarketRent Weekly Brief. To access more insights and resources, visit marketrent.us. Thank you for listening. To learn more about how Clarendon can help you achieve your real estate goals, please visit us online. We appreciate your trust in us as your go-to source for market intelligence. Our goal is to equip you with the critical insights and data necessary to make informed decisions. Until next time, stay informed and stay ahead.